Hi, Stanley here. Qualcomm is often considered a solid investment for long-term investor. After all, it's a leading producer of high-end processor for mobile devices. Its massive portfolio of wireless patents also grant it a cut of almost every smartphone sold worldwide, regardless of whether these phones are powered by its Snapdragon chips. Over the past 5 years, Qualcomm stock has risen around 180%, generating a total return of 200% if we factor in reinvested dividends. And during the same time, the S&P 500 only generated a total return of 70%. But now, as smartphones are reaching the point of saturation and many manufacturers are turning to using their own chips for their phone, is Qualcomm still a safe stock to buy now? Let's review the business, its prospect, the risk, and of course its financial to find out. But first, I'd like to thank our sponsor for this video, Seeking Alpha. Seeking Alpha is the largest investment community in the world. Seeking Alpha provides investors with a wealth of information through its data, news, earnings transcript, and crowdsourcing analysis. Both personal and professional investors find great value and investing ideas through Seeking Alpha. Personally, I find it extremely useful to keep up to date with company I am invested or interested in. You can now enjoy a massive discount on your Seeking Alpha membership using our affiliate link below. But do remember that promotion is limited time only. So now let's get back to the video. First, what is the business of Qualcomm? Qualcomm is known to most investors for its semiconductors and wireless telecommunication products. But Qualcomm now has two main business segments. Number one, Qualcomm CDMA Technologies, or QCT, which sells the company products and services. And number two, Qualcomm Technology Licensing, or QLT, which is the company's patent licensing side of the business. QCT business segment includes its most popular mobile application processor like the Snapdragon chips. It also repurposes its core mobile chips technology to serve other markets as well, such as the automotive, Internet of Things, and even personal computers. Qualcomm now also has chips for other applications, such as RF front-end chips, 3D sensors, and also fingerprint scanners. The QCT segment competes directly with companies like Huawei, HTC, Nokia, and Samsung. Apart from its physical businesses, Qualcomm also licensed out a huge part and growing portfolio of its wireless patent, now more than 300 of them. It gets a cut from the selling price of each smartphone as a royalty payment for using its telecommunication patent. Especially if you are using an Android-based smartphone, the odds are there are some Qualcomm technology inside. Historically, its QCT segment generates far more revenue than the technology licensing segment. However, from an operating margin perspective, its licensing business is much more profitable for the chipmaker. Just for example, in 2021, its QCT segment produced a revenue of $27 billion and an earnings before tax of $7.8 billion, with a decent margin of 29%. But comparatively, its QLT segment produced a revenue of just $6.3 billion, but earnings before tax of $4.6 billion. That is a wide margin of 73%. Although its licensing business is highly profitable, it has also been challenged before. For example, in 2017, Apple sued the company for $1 billion, saying that Qualcomm overcharged for its chips patent. Apple also accused the company of abusing its position as one of the only supplier for cellular technology. Both companies finally reached a settlement in April 2019. As part of the settlement, all legal action worldwide will be dropped and Apple will continue to buy Qualcomm chips again. But this shows that customer of Qualcomm has never really been that happy about its high margin business. Next, let's look at this prospect. Qualcomm's biggest potential still lies in the 5G transition. DataBridge Market Research believe that the market size for 5G chipset could grow to more than $2.5 trillion by 2029. That's a compounding growth rate of 49% a year. And that growth is due to the higher demand in high-speed internet and broader network coverage. As a leading company in this space, the handset and the mobile phone market would serve Qualcomm very well in the near future as companies start transitioning to 5G. Moreover, Qualcomm has ventured into other areas of business as well, such as its IoT and automotive segment. Its IoT and automotive stream has seen revenue growing by 67% and 51% respectively last year. Additionally, its Snapdragon chip now supports Meta Platforms' Oculus VR headset as well. So the company has some exposure into the metaverse industry as well. But Qualcomm does have some major risks with its business, one of them being competition. Back in 2020, the Taiwanese chipmaker MediaTek overtook Qualcomm as the world leading supplier of SoC or system on a chip. MediaTek really gained the ground against Qualcomm in the lower and mid-tier market range. This is especially true when the trade war started between the US and China. Chinese OEMs started placing more and more orders with MediaTek as the trade war really limited their access to Qualcomm's product. Luckily now, Qualcomm market share has rebounded and rose around 7% year on year to about 30% in the last quarter of 2021. According to a report by Counterpoint Research House, it states that Qualcomm focus on the higher-end Snapdragon chips really generated a higher profit with less exposure to chip shortages. This enabled it to grow its market share against MediaTek in the last few quarters. So there is at least some temporary good news for Qualcomm. But another key risk for Qualcomm might be China. In 2021, around 2/3 of Qualcomm revenue comes from China. Now, the company's on and off COVID-related lockdowns, its volatile US and China relationship could affect the stability of Qualcomm revenue in the long term. Looking at its financial, Qualcomm's scale enabled it to generate a stable and predictable growth. Its adjusted revenue rose about 55% to $33.5 billion in 2021. In terms of cash flow, last year Qualcomm returned as much as $3 billion in dividend and also $3.4 billion in share buybacks. Those shareholder-friendly measures really enable Qualcomm to pay a continuous dividend for nearly 2 decades. It also retired more than 1/3 of its share over the past 10 years. And unlike other tech stock, when we look at valuation of Qualcomm, it is looking very attractive at just 15 times its earning. The company also pays a trailing dividend yield of 2%. That valuation sounds reasonable as analysts still expect a 27% growth for the next year. The reason for its low valuation might be because investors might still be worried for its revenue and earning to stagnate as smartphone market reach a saturation point. Macro inflation risk could also intensify the slowdown in the economy as well, lowering demand for smartphones. While this concern might be true, Qualcomm still has many long-term strengths. Over the long term, the company has endured many cyclical slowdowns and benefited from subsequent recovery. In addition, Qualcomm has also been diversifying its portfolio away from smartphones, with chips for Internet of Things, vehicles, servers, and even PC. These new businesses might create a more diversified business and stabilize its long-term growth for the future. So Qualcomm might still be able to outperform the market for the next decade to come. So there you have it. What are your thoughts on Qualcomm as an investment? Share your thoughts with us below. And of course, if you have gotten value from this video, please give us a like and share it with a friend who you might think will benefit from it as well. And if you're ready to take the next step into investing, you can also check out our free investing course at valueinvestasia.com/free course. As always, till we meet again, invest safely.